So as you guys know, there's a lot of volatility in the market right now. And so I've been receiving a lot of comments asking me if I can talk about some stocks that I think have a lot of long-term potential, but that have been hammered this year and are trading at much lower prices. So I thought it'd be fun to pick 5 stocks that I think have been absolutely hammered this year, and especially recently trading at much lower prices than their recent highs, but that have a lot of long-term potential. So looking many years out, many decades out, these stocks that I think have a lot of long-term potential. So I think it's going to be a lot of fun. If you guys enjoyed this video, you'd like to see maybe another video of another 5 stocks, then make sure you let me know by hitting the like button or by leaving a comment down below. But with all that said, let's go ahead and get started. What's up, everybody? My name is Ale and welcome to my world of stocks. Now I know that you guys like timestamps, so I created some for you down in the comment section. And in case you're new to the channel, I just want to let you know that I'm more of a long-term investor, so I believe in dollar cost averaging as well. And that means that I'm usually buying stocks even if they're dropping in price, but your strategy might be completely different. So you should always do your own research and always make your own decisions. Don't ever be buying stocks just because you watch a YouTube video. That's a horrible idea. And also with the 5 stocks that we're going to cover today, I think I only own 2 of them, but as we go through, I'll let you know if I'm actually invested in any of them as well. All right, guys, starting with stock number 5, we got to start it off with Amazon because this is a giant company. Everybody's always talking about them. And I feel like most investors are pretty bullish on Amazon in general. But full disclosure, I have a small position in Amazon, and it is the largest stock in my girlfriend's portfolio as well. But we're both up very large on our positions despite all of this market volatility. And I don't really think that we ever plan on selling our Amazon stock because we really believe in the company very long term. But currently, Amazon is still up over 300% in the last 5 years and up over 30% year to date. But when looking at the month of October, they're down huge at around 23%. And considering that their 52-week high was over $2,000 but are now trading much lower at around $1,500, that represents a drop of right around 25% or a quarter of their price, which is a massive drop in their value. Now, despite their huge drop in price, I think a lot of value investors would still call you crazy for even considering Amazon stock. And I don't really think that they're wrong. When looking at their valuation, Amazon has a forward PE of 57, which is much higher than both the Nasdaq and the S&P 500s, who both have a forward PE of around 19 and 16 respectively. But for growth investors, Amazon has absolutely delivered, especially when looking at earnings. In fact, Amazon posted a year-over-year increase in net income of over 1,000% in both of the last 2 quarters. So why then is the stock selling off? Well, it ultimately comes down to slower growth than analysts and investors wanted to see. Now, Amazon still reported revenue that was up a massive 29% at $56.6 billion, and it was even in line with their own guidance, but of course Wall Street expected a little bit more at $57.1 billion. But the biggest issue is that their revenue growth slowed down from 39% in the previous quarter to now 29% this quarter, and they're guiding for it to be even lower, right around 15% in the next quarter. But on the bright side, Amazon did say that their holiday quarter is the most difficult to predict, and I really think that they're just setting the bar low so that they can crush it later. But how do I currently feel about Amazon? Well, whenever I've thought about Amazon, revenue growth was never really a concern, and even looking forward, it's still not a concern for me because Amazon operates in some of the biggest, most emerging markets out there. In fact, when looking at the cloud services market, Amazon Web Services grew another 46% this quarter, and while it's technically lower than the 49% they saw the previous quarter, it's still enormous growth considering that they are already the world leader in cloud services in every single region. And their operating margin for AWS increased from a very impressive 26.9% last quarter to over 31% this quarter. By the way, it drives most of their profitability as it makes up around $2.1 billion of their $3.7 billion in operating income. On top of that, revenue from all their segments grew, including online retail up double digits, physical store up 100%, commission and fulfillment fees up 31%, subscription services including Prime up 52%, and then the segment where they're seeing the most growth and is one of the most important segments for Amazon going forward is their ad revenue segment, and it jumped an amazing 122%. And the great thing about online advertising is that it brings insane margins to Amazon because all of the infrastructure is already essentially there. They've already built robust platforms to have their advertising on, whether that's Amazon.com, Twitch, Prime Video, Prime Music, Echo, you know, the whole connected home. Now they're even trying to do connected cars. So they basically have all the platforms there. All they have to do is either begin or continue to monetize them. So as they continue to reinvest in better tools for advertisers to make their jobs easier and better algorithms to make smarter recommendations for their customers, we should see ad engagement go up, and that should also attract more advertisers to their platforms. Now, Amazon already controls around half of all product searches online, and as they continue to expand worldwide, there's actually a lot of room for them to expand worldwide. You'll continuously see more products listed on their website. You'll see more sellers coming onto their website, and all of those sellers are going to need a way for their product to stand out. The only way you can do that is to pay for online advertising. In fact, some analysts are predicting that Amazon will double their ad revenue from 10 billion this year to around 20 billion in just a couple years by 2020, which, by the way, digital ad spending in general right now is projected to reach $250 billion just this year. So this is a huge opportunity for Amazon to boost their revenues. So I think revenue will always be there for Amazon. Sometimes it'll be a little up, sometimes it'll be a little down, but what I really care about is how efficiently the company is running now and how they continue to destroy any kind of earnings estimates. In fact, last year in the same quarter, their EPS was at 52 cents. This year, analysts were expecting it to be at $3.08, but Amazon destroyed that estimate, reporting $5.75, which is a year-over-year increase of over 1,000%. That's a big deal. All right, guys, now stock number 4 is a stock that I get a ton of comments on. A lot of my viewers are very bullish on this stock. And this is actually a stock that I used to own, and I sold out too early because I made some really good profits, and I just wanted to cash in those profits, and then the stock just kept taking off, and I wish I would have held it. But anyway, that stock is NVIDIA, ticker symbol NVDA. Now, NVIDIA is an interesting stock because it's currently trading for around $200 per share, but it was not too long ago that it was trading much higher at $292 at their 52-week high. This represents a drop of around 30%. So if you thought Amazon's drop was big, this one's actually bigger. But the interesting thing is that in just the past 5 years, NVIDIA stock has climbed over 1,000%. That's insane, right? Now, you're probably thinking, okay, climbing by that much that fast must mean that they are insanely overpriced and their PE ratio is through the roof. Well, I do think that their price is a little high, but when you compare them to one of their biggest competitors, one of their biggest rivals in AMD, it's actually not too expensive. When looking at their PE ratios, AMD's is 62, while NVIDIA is less than half of that at only 30. Although to be fair, AMD's forward PE does improve drastically to 28, but NVIDIA still beats that at 26. Although, again, to be fair, both companies get absolutely crushed by Intel, whose PE is around half of NVIDIA. But for all the emerging markets that NVIDIA is not only tackling, but actually dominating in, I think a lot of investors would argue that NVIDIA's price is actually pretty attractive. So what markets are those exactly? Well, NVIDIA used to be mostly just a GPU company focused on high performance gaming, graphical design, things like that. But ever since then, NVIDIA has become much more diverse. Now, that isn't to say that gaming isn't still important for NVIDIA. It makes up over half of their revenue, but I think that that's a good thing because the gaming market has been growing by billions of dollars every single year, and they even power the Nintendo Switch, which has seen exploding sales recently. And then even when you look at their 2018 fiscal year, NVIDIA grew their gaming business by 36% to $5.5 billion. That's very impressive. But perhaps even more impressive is all of the work that NVIDIA is doing in some of these other emerging markets out there. So markets like the server GPU market, artificial intelligence, the Internet of Things, deep learning, and autonomous driving. And the good thing about NVIDIA is that they are positioning themselves to be well ahead of the competition. In fact, they spend over $500 million every single quarter just on research and development. If you look at their rival in AMD, it's going to be very hard for AMD to dethrone them in any kind of segment because AMD spends about 60% less than NVIDIA. Now, when looking at the IoT market, NVIDIA recently partnered with UK-based ARM to bring artificial intelligence to, quote, billions of connected devices. And when looking at the server GPU market, it often makes sense to actually use a more powerful GPU rather than a CPU, or at least a combination of the two. But NVIDIA is making huge progress there. On the high end, their Volta GPU is being used by AI supercomputers that reduce the learning cycles of AI from days to just hours and boost deep learning performance by almost 1000%. So customers are absolutely taking notice and signing up for NVIDIA services. In fact, in their fiscal 2018 year, they saw their data center business grow a massive 133% to almost $2 billion in sales. And when looking at the autonomous vehicle market, NVIDIA is playing a big role in that with their Drive PX Pegasus supercomputer, which is set to be the size of a license plate, and it already offers level 5 autonomous driving, which to my knowledge is considered full automation. And NVIDIA claims that over 320 companies have already adopted their NVIDIA Drive platform. And while we're giving numbers for their last fiscal year, I'll just finish up by saying that NVIDIA saw revenue jump 41% to almost $10 billion, and they have a very impressive gross margin at almost 60%. So this is definitely a fast-growing company that is performing very well, and I think that they have a very bright future. Okay guys, now for stock number 3, I wanted to go with a Chinese company because a lot of these Chinese stocks are in bear market territory. They're going down, they're dropping massively. The Chinese economy is slowing down, which is really hurting these stocks. But I don't currently own any Chinese stocks except for a very small speculative play on NIO. But other than that, I haven't picked up any Chinese stocks because I really do feel like they're falling knives, and I'm kind of just waiting a little bit longer. But I am getting to the point where I might consider starting to pick up some of these stocks. But when I think about Chinese stocks, I often get the most comments about JD.com, Tencent, but I think by far the one that most people ask me to talk about is Alibaba, ticker symbol BABA. Now currently Alibaba is down over 18% year to date. They're down over 22% in the last 6 months, almost 15% in October alone. And if you look at their current price of $140 versus their recent high of $211, that represents a drop of over 33%, which is very significant, losing about a third of their value. Now, despite the enormous drop, their PE ratio is still a little bit high, but not too high. It's at around 41 trailing, but it does improve drastically, cut in half to only around 19 for their forward PE. So for that price, what exactly is it that you're getting from Alibaba? Well, you're getting the second largest cloud services provider in the Asia Pacific region and the fourth largest worldwide, who is even implementing blockchain as an added service. But you're also getting one of the most important players in e-commerce among several other things. Now, many people refer to Alibaba as the Amazon of China, but I think that they're a little more of like the eBay of China. I think JD.com is maybe a little more of like the Amazon of China, but I think Alibaba is actually like a little bit of a combination of the two, because what Alibaba does is they essentially provide a marketplace for manufacturers in China to link up with buyers who, many of which are actually in the US, who will buy products in bulk that are manufactured in China and then resell them for a premium, oftentimes on Amazon. So I actually don't really see them as a direct competitor to Amazon, but I actually see them as a very important component to the entire supply chain. And speaking to that, and China's own e-commerce market is growing at a very fast rate. In fact, some analysts are projecting that the market will grow from $1 trillion this year all the way up to $1.8 trillion by 2022, which makes total sense when you think about the fact that less than 40% of China's population even shop online. So I think that there is a ton of room to grow there. And sustainable growth is very important for Alibaba because they essentially live or die by it. Now, I'm recording this video before their Q2 2019 earnings, which by the time you watch this video, those earnings might be out. I'm not sure if they will or won't be. But when looking at their last 8 straight quarters, they saw revenue growth above 50%. And in their last quarter, so that being Q1 2019, that came in at over 60% growth year over year. That is very impressive. But when looking at net income, some investors were scared because they reported an EPS drop of over 40%. But Alibaba insisted that this was due to a one-time charge, and if it had not incurred that, they would have actually seen an increase of 33% year over year. But when looking at total retail in China, so not just e-commerce, that's expected to grow to over $7 trillion by 2020. So Alibaba is preparing for that. They see huge potential there and they want a piece of the pie. So What they're doing is they're investing in what they call new retail. You've probably heard about it because it's been in the news a lot recently. But what they're doing is they're essentially investing in brick and mortar stores by upgrading them with new technology, providing them data analytics, and just helping them survive in general. And in exchange, those brick and mortar stores will use Alibaba's services, which will boost their revenue. And then Alibaba also gets a sizable stake in those companies. That's probably a bigger deal than most people think, because only around 12% of global retail sales are even done online. Not to mention that Alibaba is also investing in food delivery services by acquiring China's biggest food delivery company called Ele.me. And according to The Motley Fool, China's food delivery market is worth $32 billion, of which Ele.me apparently controls over 50% market share. And even looking internationally, Alibaba saw the revenue from their international retail segment climb over 60% to over $500 million in the last quarter alone. So anyway, I think Alibaba is this massive company, one of the biggest companies out there coming out of China. I think they have huge potential out there in the entire world. They have huge potential. And as their price continues to drop, it's becoming more and more attractive to me. I just have to be comfortable with the idea of averaging down, because it may not be done falling yet. So a lot of people would consider it kind of like a falling knife. A lot of these Chinese companies like falling knives. Keep an eye on that second quarter 2019 earnings. If their growth is kind of slowing down, that will probably the stock will probably take a bigger hit as well. But anyway, Alibaba is a stock that I do definitely like for the future. Okay guys, stock number 2. This is a stock I get asked about all the time. A lot of people are very bullish on this stock because they bring in tons of money and they have a very strong balance sheet, and their stock has just been absolutely crushed recently. And of course, we're talking about the blue chip giant Facebook. Now, at the time of this recording, Facebook is trading for around $145 per share. And full disclosure, I went ahead and picked up a few shares of Facebook because they just have so much long-term potential. I really, especially with Instagram, I just really like Instagram, but we'll get into all that. First, let's start by looking at their stock. Now, recently, they've had some really horrible months. In July, dropping over 11%, September down over 6%, October down over 12% alone. And if you consider the fact that their 52-week high was at $218 at one point, and they hit as low as $139, that represents a drop of around 35%. So that is very significant. Now, most of this selling off has been due to data security issues, slowed user growth primarily for Facebook, not necessarily Instagram, which is just taking off, and the overall market conditions that have been kind of keeping the stock down. But when looking at their previous quarter, they missed monthly and daily active user estimates by around 20 million each, despite still being up around 11% year over year. But at this point, they have a trailing PE of 23, a forward PE of 18, and are trading well under their 50-day and 200-day moving averages, which may suggest that this is a good entry point as long as you think that this is still a good company to invest in long term, which I happen to think so. Especially when you consider the fact that they have one of the best balance sheets around, with over $11 billion in cash last quarter, bringing their current assets to a massive $50 billion versus current liabilities at only around $5 billion, so a current ratio of like a 10-to-1, which is very good. And their income statement looks pretty good as well, growing net income every year to over $15 billion last year, and it should easily eclipse that number this year as well. And according to Reuters, their 5-year EPS growth rate is over 60% versus the sector at only around 11%, and their net profit margin is over 40%, while the sector is again at only around 11%. And because of all the recent drops in price, you're essentially getting all that growth for about a 16% discount based on future cash flow, according to simplywallstreet.com. Now, Facebook did just report their Q3 earnings, and revenue came in at $13.73 billion, missing slightly higher estimates of $13.77 billion, but still up around 33% year over year from $10.3 billion. And despite growing costs and expenses by 53% because of a plan to hire 20,000 new employees to beef up their safety and security on their platforms, they were still able to increase their EPS by double digits at around 11%, which is a good sign in my opinion in terms of profit. But in the short term, I think this will continue to hurt their margins a bit, as their operating margin did drop from around 50% last year to now around 42%. But when looking at the all-important user growth, I always struggle to get exact numbers for Instagram and some of their other apps and services. But when looking at just specifically Facebook, monthly users and daily users were up 10% and 9% respectively, which even though their growth might be slowing a bit compared to the numbers they've put up in the past, I still think that it's really impressive to still be having this kind of growth on a platform that already has around 1.5 billion daily users and 2.3 billion monthly users. And I don't really even like Facebook, and I don't hear a lot of people mentioning that they really like Facebook, so some of these numbers are pretty impressive. But I do love Instagram, and despite not having specifics on Instagram, they did say that over 2.6 billion people use at least one of their services, so either Facebook, Instagram, Messenger, or WhatsApp, and over 2 billion use at least one of those every single day. So those are pretty insane numbers. And the reason why I'm so bullish on Instagram is because they have really good ad engagement rates, and they're also increasing their user count at a really fast rate. Now, Facebook may be growing their users at just barely double digits, but back in June, it was reported that Instagram had grown to over 1 billion users, which represents a growth rate of around 50% each year for the past 2 years. That's really impressive. And the great thing about Instagram is, again, their ad engagement, because they have a lot of different ways that they can target their audience. Now, they obviously do look at the age, they look at the gender, but they also look at the different interests you have, the different pages that you follow. But then they also look at the fact that most people link their Instagram to their Facebook, so they can actually use all the data from their Facebook to target that audience as well. And ads are so effective on Instagram because they're so unintrusive, at least in my opinion. You know, when I'm scrolling through the feed on Instagram, a lot of times I just scroll past ads and I don't even notice that they're ads. And, maybe part of it is because I have like a short attention span, but I think just kind of people in general right now, with the rise of cell phones and portable devices, we're all just kind of having a short attention span. So a lot of times we don't even notice that we're looking at ads and we're just kind of scrolling past it. And if it's something that doesn't interest us, we just scroll past it. It's not any kind of a big deal. There's no reason to complain or get angry or anything like that. And if it's something that interests you, you actually, look at it a little bit longer, and with all the data that they have to target you, chances are that it is something that you're actually interested in. And a lot of times you'll just kind of click on it. Now, the stories section is a little different because I could see that being a little more annoying as you're going through the stories and you kind of have to just like click or kind of swipe them to the side. But even then, I don't think it's too big of a deal, and it's not something that I ever complain about. But I think that whole style of targeting the audience with ads that they actually want to see, that are very unintrusive, I think it's a really good strategy. And I think that will continue to drive ad engagement rates, and I think it will continue to attract advertisers to the platform. Not to mention that they still have yet to really monetize WhatsApp and Messenger, which both have over 1 billion users themselves. So there's still a lot of potential out there, and I think Facebook just has so much potential in the long term, so I kind of like them. Alright guys, now for stock number 1, I wanted to go with the gaming stock because the gaming industry is just taking off and it's growing by billions of dollars every year. But gaming stocks have actually taken a really big hit recently, and so I wanted to talk about one of them. Now, there's 3 companies that I get asked about the most on this channel, and those are Take-Two Interactive, Activision Blizzard, and Electronic Arts. Now, from the comments that I see, it sounds like the most of you are bullish on Take-Two, which is ticker symbol TTWO, I believe. And they're famous for games like Grand Theft Auto, which is like, the biggest best-selling game like of all time. So Grand Theft, or series at least, Grand Theft Auto and NBA 2K is another big game. But they also have their newest game, Red Dead Redemption 2, which is already selling very well. But my favorite is actually Activision Blizzard, ticker symbol ATVI. Pretty good dividend growth stock that I talk a lot about on the channel. And they're famous for games like Destiny, Overwatch, Candy Crush Saga, Doom, Warcraft. And their newest game actually has a battle royale mode to compete with PUBG and Fortnite, and that's Call of Duty Black Ops 4, which is already selling very well also. And then there's Electronic Arts, ticker symbol EA, and this one is the one that you guys are the most bearish on. Like, I made a video on EA and everybody just kind of like hated on them, and which is fine, because I'm actually haven't really been a big fan of them either, because they've pushed so much for microtransactions, loot boxes. They've had horrible PR from management, and it's just really hurt the stock a lot. But they're famous for games like Madden, FIFA, Star Wars Battlefront, and then they have their newest game coming out very soon, and that's Battlefield 5. But when trying to talk about one of these stocks in the video, I decided to go with the one that was beat down the worst recently. So when looking at Take-Two, they're down over 8% in October, but still up 15% year to date and 20% in the last 6 months. Activision is down over 16% in October, which, by the way, I used the opportunity to pick up more shares during that time. but they're still up around 10% year to date and about 1% in the last 6 months. And then there's Electronic Arts, which is down 13% year to date. They dropped around 9% in July, 12% in August, rebounded 6% in September, but then absolutely got crushed 25% down in October alone. And when you look at their 52-week high of over 150 to now trading for around 90, that represents a drop of around 40%. That is an insanely high drop. Okay, so the winner, or I guess I should probably say the loser, is Electronic Arts. And I know that a lot of you are very bearish on Electronic Arts. You don't have to go off in the comment section. Might be a falling knife. I don't disagree with you. But I do think that they have a lot of future potential if they would just fix some of their idiotic mistakes. So we're going to talk about the bullish case for EA, and I'll also mention what I think they could do to just improve on the things that they continue to mess up in order to benefit from all of their future potential. Okay, so they started to get heavily criticized with their launch of Star Wars Battlefront 2. I think this was back in November, I think of 2017. And they were criticized for having too many loot crates and microtransactions, and gamers refused to buy the game, which led to sales coming in 1 million units lower than expected in the first quarter of release. And then EA took a horrible PR hit when fans of the upcoming Battlefield game complained about it not being realistic enough, and the CCO responded by saying, "I think people who don't understand it, well, you have two choices, either accept it or don't buy the game." And that led to gamers not buying the game. Pre-orders came in 85% lower than their rival Call of Duty, which again is a game from Activision Blizzard. And if all of that wasn't enough, Belgium is now investigating EA for refusing to follow their anti-gambling laws by keeping card packs in their FIFA games, and EA's response has basically been that they just don't care and they'll keep doing it, and so they're now facing possible prosecution as a result. Now, to be fair, EA is not the only company that does this. When looking at Take-Two, I remember playing GTA 5 online, and I remember I couldn't do anything in that game unless I was willing to pay actual money, so I kind of really hated that. And I have a feeling that Red Dead Online will have similar microtransactions as well. And then when looking at the stock that I own, when looking at Activision Blizzard, they are no saint either, because they get like over half of their revenue from DLC and microtransactions and things like that as well. But I think that EA just does it in such a like non-apologetic way that it just gets like, I don't know, I think a lot of people just kind of notice it more and get really pissed off. And you know, when I think about Call of Duty from Activision, that one, I believe all microtransactions are just cosmetic, but when it was Star Wars from EA, it was not just cosmetic. It was like everything costed money at launch. They've since fixed a lot of the things. But anyway, when looking at EA, when looking at their company, I really think about them as a massive company with some really big brands and some really good licenses that include the NFL, NBA, FIFA, Star Wars, and the list goes on. Not to mention that they have a huge game coming out right now during the holidays in Battlefield 5, and they have a very ambitious game in Anthem coming out early 2019. They also have another Star Wars game coming out by the end of 2019 called Jedi Fallen Order, which is probably going to see massive sales as long as they don't litter it with loot boxes or horrible PR. But they also recently told investors that they have multiple new games coming out by next holiday season, including games from Respawn, who developed Titanfall. So I really think that EA has all the potential in the world, some of the biggest licenses that they will ever need, and some of the biggest games that they will ever need to release. The problem is they gotta fix loot boxes, microtransactions make it just cosmetic, and have clear communication, and fix your damn PR. Your management cannot be telling your audience, cannot be telling your fan base that they don't have to buy the game, okay? They can't be saying things like that. So if they just make those tweaks, I think the company will perform much better. They've performed pretty well in the past. In fact, looking at their last earnings, they reported revenue up 30% year over year, and EPS went from -7 cents to +83 cents. So there is a lot of potential there. I just think that management continues to drop the ball. So it's not really a stock that I'm interested in yet, but I'm hoping that they just continue to drop, and maybe I can pick them up like really, really low. At that point, I might be interested in them, but right now, management is just deterring me. It's just not a company that I really want to get involved with, at least not yet. Alright guys, I think that's just about it. I hope you enjoyed the video. If you did, hit the like button, and if you want to see another video, maybe another 5 stocks, let me know in the comment section. And if you haven't already, make sure you subscribe. Thank you so much for watching, for all the support. I really appreciate it. Stay safe out there in the stock market. It's pretty volatile right now, but just be careful and do a lot of research. Anyway, thank you for watching. Have a nice day. Bye-bye.